If you think the UK housing market is safe right now, the next few minutes will completely change your mind. These 12 towns present a genuinely mixed story. Some face real structural challenges, others are quietly outperforming expectations. The national picture matters too. UK house prices rose 2.4% in the 12 months to December 2025, and most major forecasters project modest further growth of around 2% through 2026. But local markets tell a very different story from each other. Here are 12 towns worth watching closely, and why. The average price is just under £200,000. It is up 8% on the 2023 peak. That is not a market in trouble. That is one of the fast-growing housing markets in the UK right now, running at 4.5% annually. Semi-detached properties average £180,000. The first-time buyer entry point sits at £153,000. In a country where first-time buyers are priced out of most southern cities before they have even started, that figure matters. Barnsley has quietly become one of the most accessible entry-level markets in the country. The question is not whether it is falling. It is whether the demand driving this growth can sustain itself, or whether it plateaus as prices climb toward the threshold that made it attractive in the first place. Watch the first-time buyer transaction volumes. That is where the first sign of a slowdown would appear. Town number 2, Doncaster. Prices are rising here too, tracking Yorkshire and the Humber's regional rate of 4.5% annually. On the surface, that looks fine, but Doncaster was supposed to have something else by now. High Speed 2's northern leg was cancelled in October 2023, and with it went a regeneration story that had been baked into investor and developer expectations for years. Planning applications were drafted with High Speed 2 footfall in mind. Retail units were held vacant by landlords waiting for an uplift that is no longer coming. Private capital quietly redirected to Sheffield and Leeds instead. Some DN so already showing slower sales velocity than the regional average. The number to watch is not the current price, it is whether private investment returns to fill the gap High Speed 2 left behind. Town number 3, Rotherham, average £162,000, growing but below the regional rate. A market that grows more slowly than its neighbours during a strong regional period is telling you something about underlying demand dynamics. Council budget pressures in Rotherham are documented, not rumoured. Population trends are slightly negative. Neither of those facts alone breaks the housing market, but together they create a drag that shows up in transaction volumes before it shows up in headline price data. The South Yorkshire Mayoral Combined Authority has infrastructure commitments on the table. Whether that money arrives and lands visibly enough to shift buyer sentiment is the variable Rotherham's property market turns on right now. Without it, the gap with Sheffield widens steadily. Before we continue, if you find this kind of data-driven, no-nonsense property analysis useful, hit subscribe and turn on notifications. We cover the UK housing market every week with verified figures, not clickbait. You will not want to miss the next one. Now, back to the list. Town number 4, Mansfield. The challenge here is visible from the high street. Town centre vacancy rates are among the highest in the East Midlands. That is not a projection. That is what you see when you walk through it. The economic base has narrowed steadily as manufacturing relocated and retail consolidated into larger centres and online platforms. Prices are growing slowly. They are not in freefall. But slow growth in a town with structural retail decay and a narrowing employment base is a different kind of risk than slow growth in a town waiting for a catalyst. Stagnation with deteriorating fundamentals is its own category of problem. The levelling up funded projects earmarked for Mansfield are the variable to watch. If they land and generate visible employment and confidence, the price trajectory changes. If they stall in planning, the structural drift continues. Town number 5, Wigan. The average price is £178,000. It is growing, but slower than Greater Manchester's strong overall trajectory. The gap matters because it reflects a documented pattern. Younger buyers who can afford to enter the market in Greater Manchester are choosing the city over Wigan. This is not because Wigan is collapsing. It is because transport connections are not yet close enough or fast enough to make Wigan feel like a genuine commuter market for Manchester's employment base. Whether planned connectivity improvements narrow that gap enough to reactivate demand from buyers priced out of Manchester will determine whether Wigan's price differential becomes a buying opportunity or simply widens further. Town number 6, Rochdale. Prices are broadly stable. The story underneath is more complicated. Rochdale has a large proportion of older housing stock, and thousands of those properties face energy performance certificate upgrade requirements that landlords either cannot afford or have not yet prioritised. Mortgage lenders are tightening criteria on properties rated D and below, and that tightening is documented across multiple major lenders. What this creates is a two-speed market within the same postcode. Upgraded properties remain fully mortgageable and they hold value. Unimproved stock gradually loses buyer confidence and lender appetite at the same time. Whether government retrofit funding reaches sufficient scale to address the volume of affected properties is the question. Right now, it has not. Town number 7, Oldham. The average price is £172,000 and the market is growing slowly. Net outward migration among younger residents is a documented trend. When working-age people leave faster than they arrive, it creates a quiet drag that price indices are slow to capture. Council tax pressures are real across Greater Manchester as a whole. Oldham's regeneration projects around the town centre have been in planning for years. Some have moved forward, some have stalled. The demographic question, whether Oldham can retain and attract enough working-age residents to sustain housing demand, is the one that ultimately determines whether a slowly growing market stays slow or begins to reverse. Watch the town centre development pipeline. That is where the signal will come from first, before it reaches the price data. Town number 8, Bolton, not falling. The gap between Bolton and central Manchester is widening, and it shows up in a specific and measurable way. Asking price reductions in Bolton are more common than in the city. When sellers regularly reduce prices to achieve a sale, that tells you something concrete about where buyer confidence sits. Buy-to-let capital growth is limited in this price bracket. Landlords who bought expecting Manchester-adjacent appreciation have found that Bolton commands a Bolton price, not a Manchester one. That has reduced investor appetite and transaction activity in the under £200,000 bracket. The Bolton Town deal has funding allocated. The question is whether that investment generates momentum visible enough to shift buyer psychology before the gap with Greater Manchester becomes structural. Town number 9, Scunthorpe. The average is £138,000, the lowest in this group. The entire economic identity of Scunthorpe is tied to one site, the British Steel plant. In April 2025, that plant faced closure. The government responded with emergency legislation and provided approximately £370 million in working capital to keep operations running. As of February 2026, the plant is operational. But operational is not the same as resolved. The long-term ownership question has not been answered. A Northern Lincolnshire Artificial Intelligence Growth Zone bid has been submitted, with the potential to anchor over 1,600 permanent skilled jobs. Two decisions, British Steel's long-term ownership structure and the Artificial Intelligence Growth Zone outcome, will define Scunthorpe's housing market for the next decade. If either one lands positively, it changes the picture materially. If neither does, the market will be left in a position that price data alone cannot convey. Town number 10, Hartlepool. The average is £132,000. The northeast is the fastest growing English region for house prices, at 4.6% per year. Hartlepool is growing, but below that regional rate, which means it is being outpaced by its own region during the region's strongest period in years. Unemployment remains above the national average. Freeport East investment and offshore wind sector growth are cited as potential demand drivers. Those sectors are expanding across the broader northeast corridor. Whether that expansion reaches Hartlepool at meaningful scale, rather than concentrating in Teesside and larger nearby centres, is the specific question for anyone who owns or is considering buying here. Town number 11, Burnley, averaged £131,000 overall in December 2025, up 4.7% year on year. Growth in 2026 is running at 5.5% annually. Burnley is one of the fastest growing housing markets in the entire country. The first-time buyer average is £118,000, a figure that has been misrepresented in some online coverage as the town's overall average, which it is not. Rents are rising at 6.6% annually. When rents rise that fast in a market this affordable to buy in, it signals genuine underlying demand pressure. The risk here is not collapse. It is an affordability ceiling. As prices rise, the affordability advantage that drove this growth begins to compress. Whether price growth outpaces local wage growth fast enough to switch off the demand that caused it is the watch point. That compression could slow things within 18 to 24 months if wages do not keep pace. We are almost at the final town on this list, and it might be the most interesting one for West Midlands viewers. But first, if you have made it this far, you clearly take your property decisions seriously. Subscribe to the channel and hit the bell so you never miss our weekly UK housing market breakdowns. We do not sensationalise, we just follow the data. Now, the final town. Town to number 12, Walsall, an average of £202,000, growing but significantly slower than Birmingham's recovery trajectory. Birmingham is one of the strongest performing major city markets in the Midlands right now, and Walsall sits directly in its orbit, close enough to benefit, but not benefiting as much as proximity would suggest. Landlord activity has slowed following buy-to-let tax changes, a national trend, but one felt more acutely here because the investor segment represented a larger share of local transaction activity than in wealthier neighbouring areas. Fewer investor transactions mean reduced market liquidity, which makes comparable prices harder to establish cleanly. Buyer confidence is measurably lower than in Birmingham. The West Midlands Combined Authority has investment programmes in motion. Whether those programmes extend meaningfully into Walsall, rather than concentrating in the core Birmingham market, will determine whether the gap closes or becomes a permanent feature of the regional landscape. Here is what the data actually shows across these 12 towns in 2026. UK house prices are rising nationally at 2.4% annually. No collapse is underway. Northern Ireland is the UK's strongest regional market at 7.6%. The North West is running at 3.5%. Barnsley at 4.5% and Burnley at 5.5% are among the fastest growing individual markets in the country. The North East is the fastest growing English region at 4.6%. The weakest market is London, where prices are down 1% year on year. This is the direct opposite of what most national property headlines imply. Energy performance certificate compliance and buy-to-let tax changes are genuine challenges, but they are national in scope. They affect all 12 of these towns and every other town besides. Projected decline figures of 12 to 22% cited in some online coverage are not supported by any major forecaster, lender, or official data source as of March 2026. Not Halifax, not Nationwide, not the Office for National Statistics, not Zoopla or Savills. If you have seen those numbers cited confidently, they were not drawn from any credible regulated source. Here is what property owners in any of these 12 towns should actually do. Get an up-to-date independent valuation from a regulated local agent. Regional averages tell you almost nothing about a specific street or property type. If you own in Scunthorpe, the British Steel ownership decision and the AI growth zone outcome are binary events with direct price implications either way, so monitor them as closely as you would any financial asset. If your property is rated D or below on its energy performance certificate, check your lender's updated criteria now and budget for any upgrades required to maintain mortgageability. Do not make a major financial decision based on alarming headlines without regulated advice from someone who can look at your full position. The data in 2026 does not support a collapse narrative in any of these 12 towns. But it does support the case for knowing exactly what you own, where it sits in the local market, and what is coming that could change its value. That is not a reason to panic. It is a reason to be informed before everyone else.